where are you on this Fed turn? And are they too late? Is this like, are we more worried than we are glad they're out of the way?
No, for me, the Fed in 2019 have really reignited that TINA trade. There is no alternative to equities. They've pushed the 10-year down to 2.5%. Investors who are still yield-starved have nowhere to go. They're coming into equity markets. For us, looking into the second half of 2019, we think we can see valuations continuing to expand. Price-to-earnings multiple on the S&P 500 is already above its 25-year average. The Fed yesterday gave a real gift. I think that's going to drift higher. We're going to have probably solid returns for the rest of this year.
So 3K is likely? Or
we could see 3K. I think that that's a possibility. Now, the thing is, we need to be a little bit careful here. We're entering into the late stages of the economic cycle. Investors need to just be a little bit wary about taking too much risk. Don't be too greedy at this late stage.
So here's the counterpoint. The economy is slowing, and we're not getting any monetary stimulus, and we're not really getting any fiscal stimulus anymore. So why the optimism?
I think for me, the economy doesn't need that stimulus anymore. It's starting to fire on its own gears. Don't get me wrong, it's not spectacular, but it is solid. Consumers looking okay, business sentiment is looking fairly solid. Global growth outside of the US, which had been a concern for investors at the early part of this year, has started to stabilize a little bit, helped out by their central banks as well. That transition from quantitative easing to quantitative tightening, QE to QT that had been so prevalent in the second half of last year, the central banks have almost called a truce on that transition and have said, actually, we may not be going back to QE, but we're not heading towards QT quite as quickly as we first thought.
Some are a little traumatized about the reaction yesterday in the Fed. So finally, the Fed goes to where the market is, 0 rate hikes, cause for celebration. Just like the ECB, which eased further, both stock markets ended the day lower. And there's some questions as to whether central banks can still pack the same punch that they used to.
I agree with you. I think the central banks may not be the sole focus for investors like they have been for much of this cycle. Yesterday, I think it was more to do with some of the trade discussions that were starting to beef up. Let's remember, it's not just central banks that investors are focused on. The easing of trade tensions has also been a very nice tailwind for year-to-date performance. If that starts to turn into a headwind again, then maybe things are a little bit different. Our base case at the moment, though, is that these trade tensions are going to continue to resolve themselves. The Chinese don't have the stomach to go another round on the trade front after their economy got battered last year, and the US would like to see a win.
Even though we don't have a deal, and we have reports that Commerce has cleared the ability to tariff EU autos. I mean, it could get worse.
There is, and that's the risk. I think for the time being, though, with financial conditions continuing to ease, earnings downgrades beginning to stabilize slightly, I think investors are starting to see slightly more upside than there is downside. But keep a wary eye on those trade tensions. We saw what happened last year when you miss the trade tensions and it takes you by surprise. Markets can get hit. I think that's the risk.